when you're doing that, you want to be very careful that you're not pushing yourself into another tax bracket. You're not putting yourself into another IRMAA tax bracket that a lot of people are just not aware of. On today's episode, we're going to break down a really important topic, especially for retirees and pre-retirees, people that have big 401k or IRA balances and wanting to retain more control of their money in retirement through Roth conversions. My name is Dan Trinati. I am the president and CEO of 360 Financial Group and the Trinati Insurance Agency. We work mainly with retirees and pre-retirees in regards to different wealth transfer strategies, wealth preservation strategies, tax strategies for retirement. And if you do want like professional tax advice, please do seek a tax consultant. But we're going to be able to break down the Roth conversions and how much you should or should not convert, so that way you guys can keep more money in your pocket. So if you do want to talk more with us on these topics, just go ahead to our website at 360financialgroup.com/contact, and I will reach out to you personally. Without further ado, let's get into today's training here. So what we're going to cover today, what is a Roth conversion? So if you're even just new to the term, we're going to go over just what is that, so we have a good baseline of how a Roth conversion works, the importance of it. We'll go through some basics like how different retirement accounts are also taxed, and RMDs. You know, if you guys are retirees, you understand the RMDs, and you will be forced to take income out at a certain age, whether it's either 73 and a half-ish or 75, just based on whether or not you were born before the year of 1960. We'll go through some case studies here on how much to convert and maybe even when to stop. And number 5, some big common mistakes that if you're going to do any Roth conversions that you want to make sure that you avoid. So if any of these are of interest to you, make sure you do pay attention for this whole training. We will cover all of it today. So key takeaways, by the time you guys are done with this training, I want to make sure that you walk away with this knowledge right here. The 3 main tax brackets in retirement, how exactly RMDs, required minimum distributions, can create unnecessary tax pressure for your retirement. We'll go through the Roth conversions and how they provide more tax control, not tax avoidance, but how you can control the destiny of your taxes in the future, whether or not you should convert, and how much, which depends on your tax bracket, the timing, and future income projections as well. And also, by planning early, it just creates more options later. So again, we're not going to avoid any of taxes by doing this stuff, but we're going to optimize how much you need or should be paying in taxes to get more control in your pocket later on. So starting really basic, we're going to go over the 3 basic tax buckets for investing. This is just like a rule of thumb here that is really important for you guys to know, and how it controls the destiny of what your future taxes and situation or legacy is going to look like. So you have your tax-free buckets, you have your tax-deferred, and you have your after-tax. The tax-free, some people also call it just tax advantage. You pay those taxes now, right? So you pay them out of your paycheck, and then boom, you're left with whatever money, and then that's how you fund these accounts. That's going to be like a Roth IRA, an HSA, or like a Roth 401k if you have that through your employer. All of this money right here is going to grow tax-free, and you're going to access it tax-free, and these do not have RMD requirements on it. That is very important. So that's going to be your tax advantage accounts. Your tax deferred accounts, this is going to be the most traditional one that people think of. This is going to be like your traditional 401ks or IRAs, 403bs, TSPs, or even pensions. So you decrease your taxes today, but eventually when you take the money out, you're going to end up paying taxes on it. And the government is not stupid. There's a lot of ways that they're going to start taxing this, not just in the form of actual taxes, but through other stuff called like IRMAA, which is a Medicare surcharge based on how much you're making. And if you're making too much money in retirement, they will also start taxing about 80% of your Social Security as well. So when people are talking about the Roth conversions, they're going to take it from this tax deferred bucket and move it over to the tax free bucket. So you're going to pay the taxes. So let's say, you had 100K, they wanted to roll over from a tax deferred vehicle into a Roth conversion to a tax free. You're going to pay your taxes on that 100,000. So ideally it's going to come from like cash, so let's just say you're at an effective 20% tax rate. So you would have paid $20,000 in taxes today. And then the rest of that, all that 100K is going to grow tax free and not subject to the RMDs. And then you have your after tax bucket. So the after tax bucket, this is not going to be related to like any RMD stuff, but it is going to go against your adjusted gross income, which will affect what your IRMAA brackets will be. The after tax here will be like a Charles Schwab, Fidelity, just any brokerage account that you just go and you open up. I do love the after tax, especially for legacy planning. It's very important for like a step up in cost basis when you do pass away, but that's not going to be the conversation of today's talk. Today's talk is we're going to be taking the money from the tax deferred vehicles and moving over here to the tax free. So what exactly is a Roth conversion, right? We kind of just talked about it already. So you're going to be taking money from a traditional IRA, 401k, TSP, the 403b, and you're putting it into that Roth IRA. IRA. You pay those taxes now, but then all the future growth and withdrawals are going to be tax-free. So why would people want to do this? Well, we'll cover a little bit more of that in a second, but it's going to decrease your RMDs. You retain control of your money. The government's not telling you when you need to take this money out. It's going to lower your Social Security taxation. It's going to lower your IRMAA cost. And if you are married, pay attention to the end. We're going to go through what's called a widow's tax trap. It's going to give your spouse a lot more control of their money and to put a lot more money in their pocket by doing this the correct way through a Roth conversion. So why would anyone voluntarily pay their taxes today and do these Roth conversions? Because one, you're going to lock it yourself in at today's tax rates. And I know a lot of us, complain about what taxes are and how much we're paying in taxes, but in history, we're in a very low tax environment right now. So a lot of people want to lock in those lower tax rates today because we don't know what taxes are going to be in the future. It's going to reduce your future required minimum distributions. You're creating that tax-free income buckets that the government, they don't know you're making this money, for lack of better words. So if they don't make it, if they don't know you're making it, they think you're broke. In the eyes of the government, it's really good for them to think you're broke because then again, they're going to tax you less, which really helps you gain control over retirement tax planning and keeping more money in your pockets and not giving any unnecessary money to the government. I have no issues paying taxes, but I do not want to pay more in taxes than I'm required to. So why do taxes matter a bit more in retirement? The common misconception is taxes go down in retirement because you're making less. That's not necessarily true. A lot of the clients we work with, their income will be fairly similar in retirement. But a big question, if you're going to do a Roth conversion, we do need to figure out, are you going to be making more money now or are you going to be making more money later? That depends. Do we want to decrease our taxes today or do we want to decrease them later? It really just kind of depends what the US tax law is at that point in time and what your income is going to be at that point in time. And also just, think about it. The US national debt is out of control right now. And it's not necessarily the problem that the debt is increasing. So if you guys are paying attention to the news, you see the debt's going up and up and up. That's not necessarily the worst thing. The issue is that the debt is growing almost at a higher level than our GDP growth. So just the interest on the debt is growing at way too fast of a rate than the growth of our country is. And that's what's actually causing it to be a problem. A simple question you can ask yourself, do you think taxes are going to go up or down in the next 5, 10, 15, 20 years? And that would have a big impact on what we want to do with our current money. Because when the 401ks came out, just give me a little history here, the tax rate was very, very high. So people wanted to bring down their current taxes and wait until the taxes came down in the future. Well, now that we're in a very low tax rate environment, it doesn't make as much sense to delay the taxes forever. Then again, why do taxes matter more? It's because the required minimum distributions can force you into higher income, whether you want it or not. What happens when you have higher income in retirement is going to be higher tax brackets, higher Medicare surcharges, and the taxation of your Social Security, which are going to be 3 very, very big problems that could cost you an extra $1,000, $2,000 a month if you're making too much money by not doing the conversions. So when are the conversions most powerful? And here's a topic that we get a lot from clients. Like, when should I do these Roth conversions? And again, there's no perfect scenario on that. Everyone is different on when or if they should even do the Roth conversions and how much they should do. But typically, the sweet spot years that we call is early retirement, before you're taking Social Security, before your retirement and RMD age, or in your lower income years. So sometimes we have folks with a big 401k IRA balance and they're not working for a year or two, right? They're chilling, they're hanging with their kids, they got laid off, whatever it is. That is a great time to do those Roth conversions, because if you're making like $200,000 a year, you got $1 million in your 401k balance, we might not want to convert that much because you're already in a decent income tax bracket. So we just want to be careful on that. So yeah, you don't want to typically do a Roth conversion during your peak earning years. You might end up paying more in taxes than you needed to. And in just a bit, we'll go through exactly the different, like the taxation and how the tax brackets work and how much you should or should not do as a Roth conversion. And keep in mind, you do not need it. With most of our clients, we're not doing full Roth conversions for them. We're doing partial Roth conversions. So you don't have to do everything. The goal is just to fill those lower tax brackets and avoid jumping into the next one. So again, we're going to go through the marginal tax brackets here in a second so you can actually understand that a little bit more. And before we get into that, I want you guys, especially if you are married, to pay attention to this right now. This part is very, very important before we get into the tax brackets. So if you are currently married, odds are you're going to be filing jointly. So you're going to have much larger tax brackets that you can file your taxes in. You got the combined standard deduction, which would be roughly $32,000, and the same income, but you're going to be taxed at a lot lower rates. If you do not do any Roth conversions or plan appropriately, people think, oh, I'm going to be making the same amount of money. Well, here's the problem with that. When a spouse passes, you are no longer filing jointly, you're filing single. So the tax brackets nearly get cut in half. So you're going to be paying a lot more in taxes. Normally, the standard deduction is actually not reduced. You typically get to keep the same standard deduction here. So sorry about that one right there. Should have taken that off. Typically, you can keep both people's standard deduction. But anyway, you're going to have same income, but much higher tax rates, again, if we don't do any Roth conversions. So you want to be very careful about this. And understanding RMDs, right? So if you're not familiar with RMDs, if you're about 50 to 55, you need to start paying a good attention to this. So right now, RMDs typically begin at 73 or 75, just depending on when you're born, before or after a year of 1960. RMDs, requirement distributions, they're going to force you to take money out from those pre-tax accounts. And it's typically going to increase every year. The Roth IRAs do not have those RMDs. So that's a very, very big reason that some folks would do the Roth conversions, because if you wait and you have these big 401k balances and you don't need the money, you're going to have to take that money out. You have no option. You just lost complete control of how you're able to use that money in retirement. Not complete control, but the government's going to tell you how much you have to, and you have no say in how much taxes or Medicare surcharges you're now going to have to pay. So you want to be very careful about that. And again, this is just the RMD tax chart we just talked about. If you have large balance, it's going to put you in a higher brackets, larger Medicare premiums, and can cause your Social Security to be taxed as well. All right, so we're going to spend a little bit on this time right here, understanding Roth conversions and tax brackets. So I know there's a lot of information on the screen, so hang tight. So before we really get into these tax brackets, which is going to be very important to understand, you just need to understand too that Roth conversions are taxed as ordinary income, right? Just like you're getting a paycheck. So we need to figure out, are you going to be making more money later, or are you making more money now? So what's the current rate and what's the future projected rate? We do not know everything about the future projected rate, but we have a pretty good idea that it will be increasing in our lifetime. So again, we really need to figure out, what's your current income, what's your income going to be, and what does the tax situation look like? So sometimes we have clients that are making a lot of money. They don't have that much in their IRAs. They'll probably make less in retirement. It doesn't make sense for them to do some Roth conversions because they're already in a really high tax bracket. Their income's going to be a lot less later in retirement. It doesn't make sense to pay a lot higher taxes today. Most likely doesn't make sense. So now we're going through this. The strategies, we want to fill the bracket, not overflow it. And here's what I mean. So before we get into the example, I just want you guys to understand how tax rates work. Some people say, hey, I don't want to make more money because then all my money is going to get taxed at the next level. That is not correct. They're marginal. We're not even consider standard deductions. So let's just say the first $12,400 you make is going to be taxed at 10% if you are filing single. The next bracket between $12,400 and $50,000 will be taxed at the 12% rate. Anything between that $50,401 and $105,700 will be taxed at 22%. So you can see if you're filing jointly, you have a much bigger spread here. And again, the standard deduction right now is $16,100. So if you're filing jointly, the first $32,000 that you make are not even getting taxed. The next $25,000 is going to get taxed at 10%. The next roughly $75,000 is going to get taxed at 12%, and on and on and on. So the 22% to 24, I don't mind these brackets right here. If we're not making as much money, we really don't want to jump above that 12%, because 12 to 22, that's a big jump. Same as 24 to 32, that's a big jump in tax. And that's going to be very powerful on how much we actually want to convert every single year. So let's say we have a couple, just to give you an example, they're making $150,000 a year. And let's say they have $1 million in 401k IRA balances. How much can we convert? So if they're making $150, they're already in this 22% tax bracket right here. $150, they're right in the middle. So let's just say they're at that 50, and we're not even going to include standard deductions, just to keep it simple. They could convert an extra $60,000 to stay in this 22% tax bracket. Okay, cool. So an extra $60K. However, there's also, this $211,000 to $403,000 tax bracket. It's only 24%. Some of our clients are okay to take that extra 2% hit, because it gives them a much wider range that they can take advantage of these lower taxes today. Within 5-10 years, those brackets could easily jump. And if those brackets jump on us and we have nothing to do, then it actually made more sense to do a lot more of those conversions today. But we would not want to go automatically into this 32%, because then that's an 8% difference on what you're paying in taxes. That is a big difference. So, if they want to keep it simple, just according to the tax brackets, they could go about an extra $60,000 right here. However, if they want to get a little bit more, you need to say liberal or aggressive, depending on how you're looking at it, they could go up to that 403 bucket. So they could do that. However, what we're going to look at in a second are the IRMAA brackets. So if we're jumping up this amount of money in your Roth conversions, you're including that as taxable income, even though you're not seeing it, you're converting it to Roth money. We need to pay attention to the IRMAA brackets. And that's what we're going to go through next. So before we just looked at how much extra we can convert, and we could convert about an extra $60,000 according to the regular tax brackets, but we need to be careful on how much we're doing for the IRMAA IRMAA tax brackets. So again, this is a very, very big point right here, because if you end up converting too much, your Medicare costs are going to go up a lot. And we want to be very careful on how much extra we're putting up your Medicare costs. So if you're married and filing jointly, you got $218,000 or less, you just have the $202 premium per person, or $203 a month per person for the Medicare costs. If you end up making more than $218,000 and you're filing jointly, well, guess what? It just went up $80 a month, an extra $15 a month for your Part D. And so we want to be very careful. So if we go back to the tax brackets here, right, we say we make up to 211 to 218. So roughly pretty similar, right? We can do an extra 60,000. If you end up doing anything more, we might not want to go above this 274 bracket. Why? Because then you're going to be paying an extra $200 per person on your Medicare, and then an extra $40 per person for the Part D premium. So we want to be very, very careful on how much we're converting. And how IRMAA works, it goes 2 years back. So your 2026 IRMAA costs are going to be based on your 2024 tax returns. How much did you make 2 years ago? So this is how the IRMAA brackets work. And I know this might be a lot of information that we're going through. So we just want to, again, be very careful as we're doing this to not have any unnecessary or unexpected costs on your taxes. And if you have any money that's coming in from investments as well, like in the stock market, that would also count against your adjusted gross income. So you want to be very strategic on how much we're actually converting to avoid pushing you into not just higher tax brackets, but higher IRMAA tax brackets as well. And this is where the widow's tax trap comes into play. Let's say this person passed away, going back to the tax brackets, they're still making $150 a year. Let's say the income stays the same. Well, guess what? A lot more of their money is going to be taxed at this 22% tax bracket right now, an extra $50K. You had up to $100,000 if you're married and filing jointly. You only have up to $50K if you're single, right? So that's going to put an extra 10% on all this $50,000, and another couple percent from $100,000 to $150,000. So you'll be paying an extra, roughly, call it $5,000-$6,000 just in taxes from your spouse passing away per year. That's about $500 a month that you're missing out on due to taxes. And guess what? Now your IRMAA might also jump. It will jump. Right now, automatically, if you're filing single in that 150 bracket, well, guess what? Your Medicare cost just went up 202 plus 37. Just call it $240 per month. That just went up. So that widow's tax trap, that's an extra $750 a month that you are just losing out the door from not proper planning on Roth conversion, IRMAA brackets, and your Social Security taxation for your retirements. So what, just again, you guys probably know this part here, Roth conversions versus doing nothing. If we do nothing, you're going to grow your RMD base, higher future taxes, less flexibility, proactive Roth strategy. We're going to be able to lower your lifetime taxes, most likely, depending on, what your situation is, give you a lot more control over your retirement, and you don't have the government telling you when you can and cannot move the money, and you're going to have a lot more tax-free income later. It's very, very important. Some common Roth conversion mistakes, and you guys probably picked up on a lot of this as we were going through this training. If you convert too much in 1 year, it's a very big mistake. Your IRMAA tax brackets could go way up, and you might bump yourself into a higher tax bracket. And again, the IRMAA thresholds, we don't want to just jump them unless you're very well aware of what's going to happen. Forgetting about state tax. Some states don't have taxes. Where I'm based in New Jersey, there's a lot of taxes. So we want to be very cognizant of how that's also going to affect the amount of money that we have to pay in taxes if we do any Roth conversions, and not coordinating with Social Security timing. So we want to be very, very careful as we're doing Roth conversions, how much we're going to convert, and not converting a lot in 1 year without actually running the math. And that's what we're here to help with. So again, you guys already know a lot of this stuff here, but just kind of recapping everything, how do Roth conversions fit into a bigger plan? It works best when coordinated with Social Security planning, RMD strategy, legacy planning, investment allocations, different guaranteed income sources. This is just one piece of the puzzle. And for us to put together a comprehensive plan for you, we really need to know more about your situation and how much should we convert, how much should we not convert. There's a lot of different pieces that go into this. Again, final takeaways, just Roth conversions that give you more control. You're going to reduce your RMD pressure, create the tax-free retirement income later. And this is all just about strategy versus speculation. So strategy over speculation. If you guys want some more information on this, if you're a retiree or pre-retiree and you say, hey, you know what, I need proper plans, I don't want to pay too much in taxes, that's what we're here to help with. You can just go to our website over at 360financialgroup.com/contact. I will personally reach out to you. I hope you guys did get some good information from the call. If so, go ahead, book a call with us or drop a comment down below on what a good takeaway is, or if you have any questions. Anyway, I appreciate you guys tuning in. We'll catch you next time.